Hi everyone, in this video we will be going over A-Level Accounting 2022 Mi-June Paper 3-2 question number 3. This is a structured paper 3 which consists of 6 questions, each of them of 25 marks, and we're also given a total time limit of 3 hours, which means that ideally we should be spending about 30 minutes in order to complete each question. And in this video as well, we will be attempting to solve this question number 3 under 30 minutes. So without any further delay, let's get started. The directors of KPLC provide the following information at 31st December 2021. We are given profit for the year, dividend paid, ordinary share capital, retained earnings, general reserve, revaluation reserve, and debenture. And we're also told that the market price of one ordinary share on 31st December 2021 was 2.40. Firstly, we need to explain two ways in which accounting ratios may be used by potential investors to assess the performance of a business. So in order to assess the performance of a business, we could compare it with another company in the same trade in the same year, or we could compare the performance with the previous years of the same business. Let's write it down. So firstly, there is comparison of performance with another company in the same trade in the same year, or there could be comparison of performance with previous years of the same business. Okay, this concludes the first part of this question. Let's move to the second one. We now need to calculate to 2 decimal places the following. The first one is price earnings ratio, and the formula for price earnings ratio is just going to be our market value per share divided by our earnings per share. Okay, let's have a look above. We can see that the market price or market value is given to be 2.40. Let's write it down. So that's 2.40. Now we need to figure out our earnings per share. And remember that the formula for earnings per share is just the profit for the year divided by the number of outstanding ordinary shares. And in this case, we can see that the profit for the year is given to be 114,000. Now we need to divide it by the number of shares. And we know that the number of shares is just going to be the value divided by the nominal rate. We can see that the value for ordinary share capital is 600,000. And the nominal rate is given to be 1, which means that our number of ordinary shares is also going to be 600,000. Now the earnings per share will be 114,000 divided by 600,000, which results in 0.19. Let's write it down. Now the price earnings ratio is 2.40 divided by 0.19, which results in 12.63. Nextly, we need to figure out our dividend yield, and the formula for dividend yield is just going to be the dividend per share divided by the market value times 100%. And we already have the market value to be 2.40. Let's figure out our dividend per share. The formula for dividend per share is the total dividend divided by the number of ordinary shares. And we can see that the total dividend paid is given right here to be 90,000 divided by the number of shares, we just figured it out to be 600,000. Which means that the dividend per share will be 0.15. Let's write it down. Now the dividend yield will be 0.15 divided by 2.4 times 100%, which results in 6.25%. Now for the next part, we need to calculate our income gearing. And remember that income gearing is just going to be all of our finance charges divided by the profit from operations times 100%. Okay, let's have a look above in order to figure out our finance charge. Okay, so the finance charge in this case will just be the interest on debenture. Let's figure that out. We start with the amount of our debenture, which is given to be 150,000, and then multiply it with our rate of debenture, which is 8%. And this gives the debenture interest to be 12,000. Now we need to figure out our profit from operations. So what we know is that the profit for the year is just the profit from operations minus our finance charges, right? Which just means that profit from operations will be the profit for the year plus the finance charges. And in this case, we are given the profit for the year to be 114,000. Then we can add our finance costs of 12,000, which results in 126,000. So let's substitute these two amounts and calculate our income gearing. So the finance charge was of 12,000, and we figured out our profit from operations to be 126,000 times 100%. This results in 9.52%. Okay, then we need to calculate the gearing ratio. And gearing ratio is just going to be the non-current liabilities divided by our equity plus non-current liabilities times 100%. Okay, let's have a look above. Alright, in this case, so ordinary share capital is equity, retained earnings is equity, general reserve is equity, and revaluation reserve is also equity, whereas the 8% debenture will be non-current liability. Okay, so the total non-current liability will be 150,000. Now we also need to adjust this profit for the year and dividend to our equity. And remember that in our statement of changes in equity, the profit for the year as well as the dividend paid is always adjusted to our retained earnings. So let's do that. We always add our profit for the year, so that's plus 114,000. And then we subtract our dividend paid, so that's minus 90,000. Now this results in our retained earnings to have the value of 62,000. Okay, so the total equity is just going to be the ordinary share of 600,000 plus our retained earnings of 62,000 plus the general reserve of 75,000 as well as our revaluation reserve of 80,000. And this results in the total equity value to be 817,000. Let's substitute this as well as the non-current liabilities of 150,000. So our gearing ratio is just going to be 150,000 divided by 817,000 plus 150,000 times 100%. This results in the gearing ratio to be 15.51%. Alright, then we need to figure out our return on capital employed. So the return on capital employed is just our profit from operations divided by the entire capital employed times 100%. Alright, we have already calculated our profit from operations to be 126,000. Let's write it down. And capital employed is just the sum of equity and non-current liabilities, which we have right here. So that will be 817,000 plus 150,000 times 100%. Now this results in the return on capital employed to be 13.03%. Okay, this concludes the second part of this question. Let's move towards the third one. We are given additional information. The directors are considering declaring a proposed dividend of 0.20 per ordinary share, and due to the low level of retained earnings at 31st December 2021, they asked the accountant whether the dividend can also be paid out of other reserves. So the other reserves is just going to be our general reserve and revaluation reserve. Now we need to discuss how the accountant should reply to the directors. So remember that dividend is always to be paid out from the profit that we have earned, right? So the main thing to consider here is whether this general reserve and revaluation reserve consists of the profit that has been realized. Now let's talk about the amount in our general reserve. So general reserve gets its amount from our retained earnings by the transfer, right? So we basically take the amount from retained earnings and put it into the general reserve. And in case of retained earnings, remember that we add all of our profits, which means that general reserve will also have the amounts which are basically the profits that have been realized. And if it has the profits that has been realized, we can definitely use that particular reserve in order to pay out dividends, which just means that we can use our general reserve in order to make the dividends. But now let's talk about revaluation reserve. So the revaluation reserve just occurs when we revalue our assets. So there is no involvement of profits in this particular case, which means that profits are not realized in case of revaluation reserves, due to which we cannot utilize it in order to make dividend payments. Let's write these 2 points down. Firstly, the dividend can be paid from the general reserve as profits are realized, but the dividend may not be paid from the revaluation reserve as these profits are not realized. This concludes the third part of this question. We can now move towards the fourth one. We are now given additional information. The directors are thinking of investing 100,000 in a new project in 2022, and the project will generate a profit of 24,000 before interest in 2022. We have two options to raise 100,000. The first one is issue of new ordinary shares, and we have issue of a further 8% debenture. We now need to advise the directors which option they should choose. So let's have a look at our markings. So this is a 5 marks, which means that we need to include at least one advantage and disadvantage of new ordinary shares and one advantage and disadvantage of issuing debentures. Alright, let's talk about any sort of expenses relating to ordinary shares as well as debentures. We know that we need to pay out dividends for all of our ordinary shares, but these are discretionary, which means that these interests can vary and the company may choose either to make some dividend payments or they can completely choose to not make any sort of dividend payments. But if you're talking about debenture interests are fixed and they must be paid. Let's write it down. Share dividends are discretionary, whereas debenture interest must be paid. Then nextly, we know that issuing new ordinary shares could mean that the existing shareholders may lose their control. Let's write it down. The control of existing shareholders may be diluted due to issue of new shares. And if we're talking about debentures, higher non-current liabilities will increase our gearing ratio. Let's write it down. Debenture increases the gearing ratio. And debenture is basically some sort of long-term loan, which means that in order to acquire this, we must need some sort of security, but that is not the case for ordinary shares. Let's write it down. Debenture may need security or collateral, but ordinary shares do not need any such security. Alright, now based on these factors, we need to advise the directors which option they should choose. Personally, I would always favor with new ordinary shares. So in this case as well, I will be advising the directors to choose option 1. Let's write down the decision clearly. The directors should choose option 1. Alright, this concludes the fourth part of this question as well as the entire question number 3 of 2022 May-June paper 3-2. If you found this video useful, make sure you like the video and leave a comment below, and make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.